Hey, welcome back, folks. Can we get an audio check? Make sure that everyone can hear me. What's going on, Pavan Patel? All right, cool. So let's just dive right in tonight, guys. I'm just going to do a quick Q&A. I didn't really have a specific subject that I wanted to talk about tonight, so we're just going to answer general questions. I posted on Reddit, Twitter, Facebook, and so I've got a bunch of different sources that people ask questions on, and so I just kind of aggregated them all, and we'll just chat about them tonight. So if y'all are new, my name is Chris. I run Greenbar Trading. All my info is right here. If you want to check out the website or our Facebook, you can follow me on Twitter at CKZ8780. I'm a full-time trader. So if you don't know who I am, that's who I am. I trade stocks for a living, and we've been doing these weekly webinars where we just kind of get together and talk about stocks, and that's where we are right now. So like I said, for this week, I didn't have a specific subject that I wanted to talk about. So we just kind of aggregated a bunch of questions over the course of the week, and we're just going to discuss those. So if you do have questions and you haven't asked anything yet via Twitter or any of the other mediums, feel free to just type them into the chat box to the right of the video, and I will answer them for you. So let's dive in here. I got a bunch of actually interesting questions this week. Some of them were pretty funny, and some of them were very insightful. So, well, I get this question a lot here, actually. How do you use volume and price action? And the answer is in all different kinds of ways, right? So it depends on the trade. It depends on, what the situation is for, whether it's a day trade, whether it's a swing trade, whether it's good news, bad news, all that kind of stuff. But in general, what I aim for is to find stocks that have high relative volume. And what I mean by relative volume is just the volume today relative to the volume average, right? So if you look at a stock and on average it trades 100,000 shares a day, or on average it trades 1 million shares a day, you want to look at that as a the volume today as a multiple of that. So if the stock trades 1 million shares per day on average, and today it's trading 10 million shares, it's got 10 times average volume. So for me, volume is, it's kind of a tell as to how much interest there is. So I think that's probably the main thing. We did another webinar about this entitled 5 Things That I Look For on Every Trade. And one of them was volume. So go back and watch that if you haven't. It's a relatively short webinar. I think it was only like 30 minutes long or so. But that explains in a little more detail how I use volume in my normal trading. As far as price action, I think there's a few different kinds of price action. So I look for, the specific type of price action as far as, to make a decision. So you look at like any individual stock, you might see the price churning. You might see the price spiking. You might see the price grinding. You might see acceleration. So, these types of things are what I pay attention to, right? In terms of churning, is the price just kind of moving around and not really going anywhere? Is it just churning a whole bunch of volume and not really doing anything? That's going to be one of the things that I look for. Was it just a quick spike? If you look at something like SGYP on Friday, this is what I mean by a spike, right? On a 5-minute chart or a 1-minute chart, where you just have this massive, appreciation in price within a couple of seconds. This is due to a press release that comes out, right? There's a rumor that SGYP might be acquired or something like that. I don't know what the news specifically was on this one, but there's another one on Yahoo recently, last Thursday. This type of thing. So this is a spike, right? I'm going to treat this totally differently than I would this type of price action where it's just kind of smoothly, you know, grinding upwards with no rest. So churning, spiking, grinding, I look at as basically, you know, all the candles are kind of the same size, and, you know, it's not really trending where, you know, this would be trending, you know, where there's a smooth up and down action to it. Grinding is more like, you know, a straight line. So, you know, to me, if a stock is grinding, I'm pretty much always taking profits along the way. If it's trending, then I'm going to take profits into the pushes and rebuy on the dips, just because it's more established, it's more obvious, and there's opportunities to make money along the way, as well as, you know, just kind of holding your core position. So, you know, that can be extrapolated out to day trades, swing trades, whatever you want, really. But, you know, paying attention to that price action is important. And then the last type of price action that I see is acceleration. And, you know, that's where you see a stock really go, what I call going parabolic. Or if you know what a parabola looks like, right, where you have this type of thing. This is what you're looking for, a stock that's kind of slowly trending up, and then it accelerates and goes, you know, straight up. That's a big indication that, you know, the move is about to be over. So I pay attention to that as well. We saw this on HGSH on Friday, you know, going from 180 all the way to 320. And I ended up shorting this just around $3 and wrote it back down here towards the 50 period moving average. So, you know, this type of acceleration is fairly common. I've got a bunch of these examples actually, you know, just kind of saved here over time. Let me see if I can find some. So like this, all right? It's slowly kind of trending up, and then you can see the volume starts to pour in, it accelerates. This is when I always end up nailing these things to the short side, and they work really reliably. So in terms of volume and price, that's how I pay attention, you know, what I pay attention to. So hopefully that helps answer the question. Next question was how to find what to trade. Best place you can look, honestly, is in the top gainers and losers list. So you can look on something like finviz.com. You just go to finviz. Right on the homepage, you're going to have top gainers and top losers. So, you know, this is a great place to find stuff that's in play. So I'll go to the top gainers. I set it on the charts view so that I can look at, you know, a whole bunch of charts at once. And then I'll set it on the candlestick view so that I don't have any of the extra technical analysis lines that Finviz tries to draw on here. This way you have just a raw chart, you know, and you can really see the action. So this is one place that I go to find ideas to trade. You know, so I'll look at these at night, you know, and then I filter based on the things that we've talked about in past webinars, like the volume, float, short interest, those types of things. And, you know, so you can go back and watch the other webinars if you're curious about some of those other items. But this is a great place to find stuff to trade, right? I look on the top gainers list for stuff that has either gone up too much and it could potentially come back down, or, you know, stuff that hasn't really taken off yet, but it could. And then on the top losers list, just the opposite, right? Stuff that's gone down too much, which could potentially bounce, and stuff that has just started breaking down, which could potentially continue downwards. So, you know, these are the stocks that are in play. These are the things that have news. They've been running for a while. They've got some kind of catalyst driving them. So these are the ones that I usually pay attention to. On top of that, I also use Stock Fetcher, which is a scanner. And so I can actually write my own filters to look for specific patterns on the charts. And so every night I go through my Stock Fetcher scans, and I'll pull up some ideas, you know, from here. So, you know, via Stock Fetcher, via Finviz, you know, another good place to find stuff is on Twitter, honestly. You see people posting about things all the time. You know, some of these guys, they just post a chart, you know, and they draw some lines on it. You know, so this stuff is all good, right? All of these places, can generate ideas for you. So, Twitter, StockFetcher, FinViz, and then during the day, I have a sort of an intraday top gainers and losers list, which is in my Dash Trader software. So this is through my broker, and it will just update automatically all day long with whatever the top gainers are. If you guys use Thinkorswim, they also have a similar type of thing. I believe it's called the top percentage gainers and top percentage losers. And then there's also like a lovers and losers list, which is, just like the hottest stocks for the day based on volume or based on news, or I don't know what it's based on. But, there's those types of scans exist in Thinkorswim as well. So with all of those things, right, I can find stuff to trade. What else we got here? Okay, so this question, how can you manage risk as a new trader to keep from blowing up your first account? This is a good question because this is an issue that a lot of traders have, obviously. Where is, trying to get the YouTube video back on the top so I can see your questions. There it is. All right, on my other screen, that is. So how can you manage risk as a new trader to keep from blowing up your first account? Well, that's really hard, right? So I think the best thing that you can do is just to make sure that you're not over trading. One of the biggest things that I see as, both a guy who used to be a new trader, right? Just like everyone was, but also now as a teacher and a mentor, and as someone who's kind of been through all of that and, had those problems and found success with it. One of the problems that I see with a lot of traders that I work with is that they just trade too much. In this business, less is more. You only need a couple of trades per day, really, to make a living at this. There's very few traders out there, in my opinion, that can make 10, 15, 20 trades a day and be successful with it. My mentor always told me when I was first learning how to trade, you're only capable of making so many good decisions in one day. And once those good decisions are exhausted, you're going to start to make mediocre decisions, and then you're going to start to make bad decisions, and the effect snowballs on top of itself. So, I would say my best advice in terms of managing risk is just make sure that you're not trading too much. Make sure that anything that you are trading is something you're really confident with. And it might be hard to find confidence when you're a new trader, but, think back to the things that got you interested in trading. What was it that, what was the, your first trade that you were really, really confident with, that actually worked out for you? So those types of things, I find to be very helpful just because, confidence is such a huge thing in the trading world. So for me, it's about, trading less, but trading more deliberately and more constructively. And, and just about making sure that whatever I am trading in, I'm very confident with it. Regardless of whether or not it's right, like you should be confident with, your trading strategy, because if you're not, then you're going to second guess yourself. You're going to stop out too soon, and you're going to take small losses, or you're just going to, kill yourself with death by a million paper cuts. So that would be my advice. The other thing is, have rules. If you can work with a broker that has like a max loss cutoff where they can actually stop you from trading if you, if you go too far into the red, there are brokers out there that can do that. My broker does it. I keep a max loss on my own account just because, you never know when something's going to happen and you're going to go into kind of, you're going to go into tilt mode and just, go crazy. And it snowballs really, really quickly. It can get out of hand before you even realize it. So I have a max loss rule on my account, which will just shut me down if I, have a bad day. So, you can try to find a broker that does that. The other thing that you could do is, just make up a system of rules for yourself, and stick them to your monitor. maximum amount of risk that you're willing to take per trade, maximum daily loss based on your account size. If you've got a $20,000 or $30,000 account, you shouldn't be losing more than like $400 or $500 on any day. If you're down $400 or $500 on a $20,000 account, then just take the rest of the day off. You're done. If you try to fix it, you're just going to exacerbate the problem. So that would be my advice. That actually kind of blends nicely into the next question as well. How can you day trade effectively under the pattern day trading rule? This question actually came from somebody who is not eligible because they're not eligible to day trade, basically because they don't have the limit for the pattern day trading rule. So unfortunately, there's not a whole lot that you can do. The rule is the rule. I mean, if you're in the United States, you got to have at least $25,000 in order to day trade. And if you don't have it, then you can't day trade. You can day trade 3 times within a 5 business day period, but with certain brokers, even if they notice a pattern of you repeatedly, riding the limit, taking 3 day trades, they'll flag you as a pattern day trader anyway. So the best thing that you can do is, again, going back to, how you manage risk, just trade less, seek to find, just 1 or 2 day trades per week, and everything else should be looked at with a swing trader mentality. What I used to do also before I had enough to cover the pattern day trading rule was I would buy like right at 4 p.m. on something that had a strong day and was closing right on highs. And I would just take the gap in the morning, because buying at 4 p.m. one day, right before 4 p.m. one day, and then selling it in pre-market or selling it first thing the next morning, you're effectively you're holding it overnight, which is risky, obviously, if news comes out. But, if the stock's got momentum, something like VRX recently, it was driving all the way, into the close on the 6th of April here. Actually, let me turn pre-market back on so that you can see exactly what happened. So you can see it was actually driving, this is 4 p.m. right here. So it's actually driving all the way up right into the close, and it closed almost on its highs. It's the first time that the stock had any real strength in quite a while. So, this is the type of thing that I would just snag it at 3:55 p.m. and either sell it, in pre-market the next day, or I would sell it in, in the next morning. Because you can just catch these gaps, and sometimes they're pretty big. So that's another way that you can kind of avoid, I guess you'd call it, wasting a day trade. It's just by playing the gaps. What else do we have here? Okay, yeah. So a guy on Twitter asked me, what's your average hold time? It really depends on the trade, I guess. For day trades, I'd hold anywhere from 10 minutes to a few hours. If it's a quick trade, like one of these intraday parabolics, like CBAY here that we just looked at, this is only a 15-minute trade. But then I'll have other trades, actually, and a lot of these parabolics are like that. This one, AAP, from a while ago, parabolic short, was only 10, 15 minutes long. So, this is actually, I've been doing this a ton lately. For the last 6 or 8 months, I've been trading these parabolics. And, these ones are really short, at least for the initial piece of it, because you're going to catch that quick snapback. And then once it kind of bounces and starts to fizzle, if it's an exaggerated move like HGSH was on Friday, you're going to get a much longer fade back down. So this one I shorted at $3 right here, and I covered at 265 within 5 minutes. But if I had had more size, I probably would have just covered half of it or covered a third of it, and then held it for a little while longer. One of the things I'm finding is that with these parabolic shorts, they tend to always be kind of magnetically attracted back to this 50 EMA on the intraday chart. So I've been trying to let them run a little bit longer, and until they touch that 50 EMA. But, it's not always easy when you instantly make 35 or 40 cents on a stock, especially if it's only a $3 stock. So, this is probably my norm lately, is just like 10, 15 minutes. But, I also have trades where either I was wrong on the entry, like this ALNY. So I had to, average in a few times in order to kind of fix it and get my average price where I wanted it. Those ones tend to take longer. Sometimes I end up stuck in these things for 3 or 4 hours because of that. And so sometimes they're just, a quick trade. This one was a little bit longer, but still not super long, right? I started in at like, I don't know, 2:15 p.m. and I was out by like just before 3:30. So, it really just depends on the trade. And also it depends on the daily chart. If there's also a really nice pattern on the daily, then I will, tend to run these things a little bit longer just because you're working with a higher time frame. As far as swing trades go, 3 to 5 days usually is like my average hold time. If the stock's working for me, then I'll hold for 3 to 5 days. If it's not working, then I don't know, hold it until it hits my stop loss, I guess, or until I find something better to buy. Robert Mancini is here. Welcome, sir. Ask away, whatever questions you got, my friend. Okay, next question. How do you use Vweb? Well, that's an easy answer. I don't really use Vweb. I don't use very many indicators at all. I just have this 150 exponential moving average, and then I keep the 200-day moving average on my daily charts. So I don't like indicators because all indicators for the most part are calculated based on price anyway, price and or volume. So as long as I have price and volume on my charts, I don't really need extra lines to tell me, when I should and shouldn't buy. What I find is that indicators overall, they just make me do stuff that I normally wouldn't do. They just give me an excuse to trade when I shouldn't. However, if you do use Vweb, what I would say about it is that I have used Vweb in the past, by the way. I know a lot of people that use it. So I understand very well how it works. I just don't personally use it. But what I found is that, if the price is above Vweb, the theory is that it's supposed to continue going up until, it's going to stay above Vweb, basically. Once it breaks through Vweb, then it's, the theory is that the trend has reversed. And if it holds below Vweb, then you can expect the price to continue down until it breaks back above it and holds. So the people that I know that use Vweb, the way that they use it is to time tops and bottoms. I know people that will use it as a bounce point. So if a stock takes off first thing in the morning, a pullback to Vweb might be a good entry. Also, if a stock has been, went on a big morning run and it's been kind of static, it's been stuck at the top all day. I know people that will use Vweb, when it breaks Vweb in the afternoon, like this one kind of busted the 50 EMA around noon here. And then it held underneath it. The 50 EMA is somewhat similar to Vweb, I've found. So I guess in that sense, I do use it. But, if it cracks through the Vweb and then holds underneath it, some traders I know will use that as a short signal, signal to go short. And then also if it's a stock that's been beaten down and it's trying to reverse trend to the upside, if it breaks above Vweb and holds above it, then you could use that as a potential buy signal for a longer term move. So I don't personally use it, but that's what I know about those who do. Okay, next question. What considerations should be made when swinging short? So for anyone who doesn't know what swinging means, we're just talking about swing trading. So buy and hold for a few days versus, buy and sell in the same day. All right, so buy and hold for a few days or a week or 2 weeks and then sell it, right? So it's short-term active trading, basically. And what shorting refers to is basically banking on the price going down. So instead of buying shares at a low price and then selling them higher, what you're doing is borrowing them from your broker immediately selling them at a high price and then buying them back at a lower price so you can give them back to your broker. So there are some considerations that should be made when you're swing trading to the short side. First of all, I don't actually swing trade short that often. And there's a few different reasons. The first reason is actually the first consideration as well. You have to consider the borrowing fees. So for each stock that you are shorting, there's going to be potentially borrowing fees for that. It's either going to be a per share fee or it's going to be a per share fee plus interest on the margin, because the broker is essentially giving you a loan for the value of whatever shares you want to short. And just like any other loan, they're going to charge you interest on that. So if you end up, swing trading short, you're going to be paying that interest. So if it's only for a few days, not a big deal, right? But the problem with swing trading short is that if a stock gets halted, you're going to end up stuck until the stock gets unhalted, paying those fees. And I've seen people in the past have, been in stocks that were, very shady companies. And so they were banking on the companies going bankrupt, and they shorted them and they were right. The stocks get halted and then they ultimately end up getting delisted or the company goes bankrupt or whatever. But the problem is it takes 7 months for them to unhalt the stock. And so they're stuck paying borrowing fees for 7 months, So even if you're right, you make 100% on your trade. If it goes to zero, you might have $50,000 in borrowing fees, even if you made $50,000 on a trade. So that's one of the considerations is what's the interest rate? What's the risk of it being halted? And am I going to get stuck paying these fees? Another consideration is, does the broker have shares to borrow? If you've got a good broker, they should have shares to borrow. You might have to go out and actually, have them locate them from another broker or from a clearing firm. But that's one of the considerations as well. So for me, I definitely consider the borrowing fees. I definitely consider how hard the shares are to come by. I also absolutely consider the risk of news, because with shorting, you can lose forever. You can end up in a situation like KBIO or AQXP or CPXX, where these stocks gap up, hundreds of percent. It's different from going long, right? Because the stock can only ever go to zero if you're long. But if you're short CPXX at $1.50, and you think it's going to zero, and then all of a sudden you find out that they have a drug that performs better than the standard of care in treating leukemia, stock gaps up 800%. You're down 800%, right? You now potentially owe the broker money that you might not have. So, that's obviously a risk of swing trading short, which you should definitely consider. Next, do you have certain rules when it comes to holding positions overnight? Yeah, so just in general, obviously all the stuff that we just talked about in terms of swing trading short, I also have rules just in general for holding positions overnight, whether they're long or short. Probably the biggest one would be, I got to have a profit on the trade. If it's a day trade that I'm deciding to hold overnight, then I want to make sure that I have a profit on the day trade and I'm just holding a piece of it overnight, right? To get like that gap that we talked about on VRX. I basically want to have a profit cushion if I'm holding overnight. If it's a stock that I intended to swing trade, like the other day I bought into this NWBO and I was going to swing trade it. So I bought this at 169, which was right in this area. I actually bought it in the morning and then held through this little flaggy thing. And it actually took off pretty nicely that day. But then the following day, it kind of fizzled. And so I actually got out of it 171. So I cut it off right here as it broke down. And the reason that I got out of it is because I wanted a quick move to the upside since the company has earnings on Wednesday. So since they're releasing earnings, I don't want to hold through earnings. That's one of my rules and one of my conditions for any kind of trade. I never hold overnight through earnings just because I don't know, what the earnings are going to be. I can't predict the future. I can't predict, even if I could predict the future, I can't predict, how the market is going to react to good or bad earnings. I've seen companies beat their earnings expectations and tank. I've seen companies miss their earnings expectations and go up 50%. So you really never have any idea how the market's going to react. So for me, that's one of my major rules for holding short overnight, holding short or long overnight, is just, don't hold through earnings, basically. That's really, I think, the only like steadfast rule that I have for swing trading. Never hold through earnings, never hold through any kind of major news. So I don't speculate. I don't gamble on news. I would much rather wait until the news comes out and then, play accordingly, whichever way the market wants to go. There's just as much money to be made that way, and the risk is way lower. The other rules that I have in terms of swing trading, I guess, would just be I tend to give things wider stop losses. And I tend to just, risk more on them just because it's going to be a multi-day position. So if your average risk on a day trade is, $300, then your average risk on a swing trade might be more like $900 or $1,000, just because you're probably going to hold it for 3 or 4 days. So you can kind of extrapolate it out and just call it 3-day trades. So, that's one of my rules, is I just generally risk probably 3 to 4 times as much on swing trades, just because they're going to ultimately give me bigger profits. Okay. So next question. This was actually a pretty interesting one. One guy asked me, what is the point of having trading hours if it's always lunchtime somewhere? Basically, he was saying, there's people all over the world that can trade stocks, in all different countries. They can all trade on US exchanges if they want to. So, why do we have trading hours? And, I thought it was kind of an interesting question because it's something that people don't really think about. But, the answer is, first of all, not everyone can trade on US exchanges. These stocks don't always trade. Like, stocks that trade on a US exchange often will not trade on another exchange, right? So just because a stock is on the US market doesn't necessarily mean that it's also trading on Toronto. It doesn't mean that it's trading in the Tokyo exchange or the London exchange. So, and oftentimes they're not, right? They're trading in their kind of home turf. So, that's the first thing, I think, is that, these stocks don't trade all over the world, right? So, and the other obvious reason that we have trading hours is because the equipment that's in New York, and the buildings that it exists in, right? It takes people to run that stuff. And people need to go home and spend time with their families and eat dinner and lunch and stuff. So, that's really the obvious answer, right? Is that the exchanges, the exchanges have to shut down at some point because otherwise nobody would ever sleep. It's not fully automated. So, that's why we have trading hours. And they're actually, in my opinion, with pre-market and aftermarket, they're pretty lenient. Plus, if you really wanted to trade 24 hours a day, you could, just by trading futures or Forex or something like that. So you could switch from trading stocks to trading futures and trading Forex, and you could trade around the clock if you wanted to. You could open accounts in other countries. You could have, exchange accounts on different stock exchanges, in different areas. So not on different stock exchanges, but just in different areas. So you could trade on different stock exchanges. So that's why. All right, next question. What is going to happen with SUNY? Well, let's find out. So I haven't actually looked at their situation in a while. I know that they were kind of teetering on the edge of bankruptcy. So, that would be my short answer, is most likely the company's going to file for bankruptcy. I know their Vivint Solar deal fell apart. These guys have a ton of debt, and they don't really have any way to pay it. So, the bottom line is they're probably going to file for bankruptcy protection. As far as what comes out of that, yeah, see right here, Sun Edison falls more than 50% after report of bankruptcy plans. So I don't think that I haven't updated myself on the news from the company recently. So I don't know if they actually announced bankruptcy or if it's just still a rumor. I mean, I think it's pretty much official at this point. Yeah. SunEdison stock plunges as bankruptcy looms. Terraform Global is now suing SunEdison, saying they misappropriated $231 million. SunEdison CEO cancels Wharton graduation speech. I mean, it doesn't look good. It looks like the company is going to probably file for bankruptcy and disappear. They're gonna reorganize into something else. I mean, they have a lot of debt, so I don't know exactly how bankruptcy protection works in terms of reorganizing their debt. But the bottom line is, what's going to happen with SUNY? They're going to file for bankruptcy, and it's no longer investment grade. I don't think it was ever investment grade, but it's definitely not investment grade at this point. Unless you like buying bankrupt companies, then I suppose it is. So that's my theory. Okay, another interesting question I got. This guy had posted a link to this Zero Hedge article saying that smart money has been making an exit over the past couple of weeks. And I read through the article. I thought it was kind of interesting. They're pointing out that Bank of America, Merrill Lynch clients, hedge funds, private clients, and institutions, you're seeing basically net outflows, like everyone is selling, essentially. And yet the market has rallied for the last few weeks from the lows here around 182 up to where we are now. We've kind of reclaimed the 200-day moving average on the S&P 500. And, so the question, I guess, is why, if institutions and hedge funds and, the smart, quote, smart money has been exiting the market, why is the market rallying? And should we expect a price decline? And I guess really the answer is, I expect the price to decline to some extent. I think now that we have Yellen being a little bit dovish in terms of, the Fed policy, I think that's put that's put people at ease to some extent, that we're not going to have any super aggressive actions from the Fed, like raising interest rates again. The last speech that she gave, they seemed like they were pretty much, playing it cautiously. So I think that is definitely a factor in why the market is holding up as well as it is. I think people are just looking at it and saying, well, maybe smart money is selling, but overall, we're not expecting any major aggressive actions from the Fed. So it's kind of a weak buy / hold type of market rather than a sell type of market. But I do expect, just because we've come all the way from 182 up to, over 206 here in a relatively short amount of time without very much rest, I do expect, at least some pullback and some consolidation as the people who were lucky enough to snag down in this area, start taking profits on those positions. So that's my theory. I don't know if that's right. I'm not an economist. Half the stuff in this article is not relevant to the way that I trade at all. But I still thought it was an interesting article, and that's my thoughts on it. Robert Mancini wants to know if gold will hit 1,500 again. Let's find out. So we have GDX, we have the ETF. I have to actually pull up Thinkorswim. What's gold at right now, Robert? I don't actually know. I haven't been following gold. I have to pull up Thinkorswim to actually see gold itself, because I don't think I can look at it in DAS. But looking at GDX here, it looks pretty bullish. I've seen actually a lot of gold stocks pop up on my scans recently. So, gold does look bullish, at least in the short term. 1240. Okay. Yeah, let me pull up Thinkorswim here and actually see. What it looks like. Dun, 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 dun. Yeah, I mean, I'm not an economist, so I don't really know, but we'll see in a second here. So let me look at gold itself and see what the chart looks like. Whoops. I'm doing this on my other monitor, by the way, if you're wondering. Okay, so the daily. Yeah, I mean, let's make a quick screenshot of this over here. So yeah, I mean, the daily, it does look like it's kind of, consolidating here. So I don't know. I mean, I don't know where the level of 1500 comes from that you're talking about, but it looks bullish. I'll say that much. I don't care if your next question's long. You type as much as you want, man. So yeah, I mean, to answer your question, I don't know if it's going to hit 1500. I'm not sure where that level is coming from because my daily chart actually doesn't go back that far, and I guess I could change it, but let's look at a weekly. 1500. 1500 is pretty far away. Maybe like 1300. Looks like you're going to have resistance at 1300 and then again at 1350 and then again at 1400, just from, looking at it from a purely technical standpoint. That's what I would see. For anyone who's curious, you can look up, if you look at the gold futures in Thinkorswim, there's a watch list that has the futures symbols in it. In the public watch lists. So you can pull it up in there and look at it if you're curious what the chart looks like. That's what I'm looking at right now on the other monitor. Okay, so next question was, is Under Armour a good buy after their kind of pseudo 2-for-1 split? This actually came from Reddit. And yeah, there was a guy that was basically asking if the stock is a good buy for newcomers, right? If you're just now starting to follow the stock, because they just split their company 2-for-1. So they did something a little bit strange. Rather than do a standard split, what they did was issued new shares. And I think that they issued a new class of shares, and that I think confused a lot of people. But it's basically the same thing as what Google did, where we have GOOG and we also have GOOGL. This is effectively, a 2-for-1 split. The way Under Armour did, with UA and now UA.C, is what's, the equivalent of Goog and Google here. So basically what they did was UA was the Class A stock, and that's what everybody owned already. And then you had UA Class B, which is what the CEO of Under Armour owned. And the reason that he split them off is because he wanted to retain voting power. And the Class B shares had, more voting power. So he owned Class B shares. And the reason that he didn't want to just distribute more, of the Class A and Class B shares is because it would dilute his voting rights. And he wants to maintain control of major decisions for the company. So instead, they created this new class of stock called Class C, which is UAC, UA.C. And they issued those, at least this is the way I understand it. And they issued those at effectively, 50% of the price. And so now you have 44 and 43, which is, 50% of what it was before. So really, if you owned UA, you didn't lose anything, right? You UA, you now own UA at half the price that it was, plus you own an equivalent amount of UA.C. The only difference between the two is that UA.C doesn't have the same voting rights as the Class A and Class B stock. And that's only so that the CEO can maintain his control over the major decisions. So the question that you have to ask yourself then is, do you trust the CEO to make good decisions? Because if you do, then great. I would say this is, still a buy, because nothing has changed, right? The value of the company hasn't changed. The only thing that they did was make it effectively more affordable while still maintaining, while the CEO still maintained his ability to control most of what goes on. So that would be my just kind of 5-minute analysis in terms of, how to actually value it. Obviously, you got to look into the financials. You got to read the annual report. You got to do your own research and due diligence in that respect. And that actually brings us to the last question, which was, how does one value a company? And this is obviously a long discussion, but I'll give you kind of some of the things that I look at. This person had asked, what are some good resources that allow one to access a company's progress? And, how do we value a company? So the first thing that I always do is read a company's annual report. I want to know what their money makers are. I want to know who their customers are. I want to know how long they've been around. I want to know where they're located. I want to know what their financials look like. All that stuff is going to be included in the company's annual report. And we actually did, the first weekly webinar that we did was on analyzing a company's annual report. And that's available on YouTube also. But basically you go to edgar.sec.gov, click on company filings, and then throw in your ticker symbol. So in this case, we'll look at UA. And then the 10K is the annual report. So this is where I would start. And I would literally read the entire thing. I would read top to bottom. I want to know everything about their business. I want to know everything about their risk factors. I want to know any lawsuits that they're involved in. I want to know everything I can about the company. Financial data. I want to pay very close attention to the management's discussion and analysis of financial condition, or the MD&A. I also want to pay special attention to financial statements and supplementary data, meaning the financial statement notes, all of the footnotes, basically the fine print. You want to make sure you pay attention to all that stuff. So read this in detail. This is going to give you a really good idea of what the company's worth. Once you understand what their money makers are, you kind of understand everything about the company itself and how they make their money and who their customers are and all that. It's going to make it a lot easier, to value them versus their competition. It's going to tell you, how they stand out from their competition. It's going to tell you what products they have that their other ones don't. It's going to tell you what their competitive advantages are, all that kind of stuff. You're going to be able to deduce that by reading the company's annual report. So that's where I start. Once I've done that, I'll also go through their financial statements, which are, like I said, they're also in the annual report, but you can find them on Yahoo Finance or Google Finance. There's a number of different places. Look at the income statement. You want to know, are they profitable, right? Are they making money? Are they in a good position in terms of assets versus liabilities? Are they in a good position in terms of operating cash flow? In other words, cash coming into or leaving the business based on operations, right? Just actually operating the company, running the company. Is that bringing in cash, or are they burning cash in doing that, right? That's being cash flow positive is obviously a good thing. So, I'll look at that type of stuff. And then, you could use a site like csimarket.com. And CSI Market has much more in-depth analysis in terms of their fundamentals. So you could look at their growth rates. How quickly is their revenue growing? How quickly is their income growing? How quickly are their expenses growing? What's their profitability? What are their valuations, like their PE ratio? their price to sales ratio, all that kind of stuff. That can be deduced from here. And as far as what to look for, I mean, that's where, the discussion gets really long. So unfortunately, I can't talk about all of that in just a quick webinar. But, a lot of this stuff can be Googled. Also, this is one of the things that I work with my students on in, our mentoring program, is learning, how to analyze all of this stuff. So I look at, their revenue growth, their operating income growth. I look at their expense growth. I look at how profitable they are in terms of margins, right? Operating margins, net margins, gross margins. You want to know how much of their revenue they're actually keeping. You want to know how that compares to their competition and how it compares to the industry. So, this is where it comes down to valuing a company. It's a very complicated subject. It's very, very difficult to do. I mean, there's been entire books, entire libraries probably that have been written on this subject. And I don't claim to know that much about it. I am not a financial analyst. I'm a trader. So I do understand, the major stuff like, margins, growth rates, valuation, efficiency ratios, those types of things. But, this is an incredibly complicated, incredibly complex subject. So, you're going to have to do your own research on a lot of this in terms of how you actually assign a number to a company, but hopefully this will get you started. So that is all the questions that I got for tonight. There's a few more in chat here that I'll get to in just a second. But so if anyone has any follow-up questions, if you're one of the people who asked one of these questions and I missed something or didn't cover it the way that you wanted, just, throw it into chat. Let's talk about it a little bit more. But, I'll dig into some of the other questions in chat here. So, okay, one person's asking here, if you're trying to build an account to clear the pattern day trading rule, would it be wiser to enter a swing trade later in the day in case it makes a move to your stop and uses one of your day trades if you don't have two accounts? Yeah, actually, when I was swing trading more, I would often wait until towards the end of the day to take swing trades. Not necessarily because they're more likely to hit my stop if I buy them earlier, but more just because I have a better understanding of what the major move is going to be. After the stock has been trading for the entire day, you kind of know at that point, whether it's a long or a short. So, I just like to wait until I know in terms of swing trading. So yeah, I would often buy like 3:30, 3:45 p.m. and just hold overnight as my swing trade entry. Robert was saying that the 1500 number came from a measured move analysis of that cup and handle, which is legitimate. Yeah, I see what you're saying. Whoops. It's gone. I don't know where that screenshot went. But yeah, I see what you're saying, Robert. You're going to hit resistance at some point before that, though. It's going to have trouble at 1350. It's definitely going to have trouble at 1400, in my opinion, and possibly 1300 as well. But those round numbers, they always give you problems. So any other questions, guys? Feel free to ask. Otherwise, I'm out of here. All right, cool. Looks like we are pretty much done for tonight. So, once again, if you guys ever need to contact me, feel free to just hit me up on either Twitter or you can email me info@greenbartrading.com. I have a blog on my website as well, which is completely free. You can go there and check out all the articles. I've maintained it since probably 2012. Oh, we have another question. This gentleman would like to know, when you lose a lot of money, how do you get over it? I actually wrote a blog post about that a long time ago. Let me see if I can find it. Yes. I will post this link in the chat. So to summarize this blog post, you know, the main thing is there's more to life than trading stocks, ladies and gentlemen. I mean, when I have a bad day, when I have a really shitty day, like my kind of go-to method of getting over it is just to go do something else. You know, I like to distract myself with something mindless that I don't really have to think about, whether it's just, you know, sitting around watching TV or, you know, going out to dinner or I don't know, just anything to get your mind off of it, basically. You know, that's how I handle it. But you want something that, you know, is not going to, you know, it's not going to take a lot of stress to think about it. You know what I mean? You want something mindless. Go for a walk, you know, go exercise. There's all kinds of different things that you can do, right? But the point is there's more to life than trading stocks. What I find that people have a tendency to do is like they'll immediately go into analyzing what they did wrong and trying to figure it out. And it just snowballs and exacerbates it because, you know, you're just constantly stressed about it. Sometimes it's best to just disconnect for a few days and just walk away. So that's how I handle loss, which I have had much of over my career. So I'm good at it by now. All right, cool. Well, thanks for coming, guys. Always enjoy your questions and enjoy chatting with you. So if you have any other questions, if you have anything that you want to get in contact with me about, websites here, Facebook, Twitter, Ticker TV, Reddit, TraderView, mentorship, email, whatever you want. I'm always around. And now actually you can hit me up on YouTube as well. I don't even know what my channel is. I think it'd just be youtube.com/Greenbar trading. Maybe. Nope. I don't even know what my YouTube link is. I got to look it up. But anyway, I'll post it on Twitter and then you can just bookmark the channel. So thanks a lot, guys. I'll talk to y'all soon. Have a good night.